What's up, guys? Zach is back with another episode of Journey to $1,000,000. And the markets are still bouncing around, still choppy. Tech is having a hard time. The cyclicals transition is still going on. And actually, they're doing pretty good. Financial sector is doing all right. Energy is doing pretty well. Also, the home construction. I really do like this ETF that we discussed before. But I mean, there's a lot of stuff going on, and the NASDAQ is hitting big resistance right now, which I would like to talk about in today's episode. And as well as two different schools of thought. And now this is actually from the post that I made on ProStockAdvice.com yesterday. And I didn't get a chance to make a video on it. I got some life event coming up. Actually got a surgery going on Wednesday, so yeah, I might be posting a little bit less because of that, but hey, it's not a major anything like that. But yeah, it should be fine. So probably I still will be posting. You'll see me here day of, but anyways, doesn't matter. So yeah, got some things going on, but still trying to put up as much content. So if I don't, I do apologize about that. But actually, you know what? On Twitter, the trading, the short-term options, if you guys have been following along, you know I don't really do much of this during these periods where the market is way too choppy. Because even a lot of people think NASDAQ is going down, tech is bearish, the transition is still going on, the 10-year is up, although all of that can change within a matter of within a matter of hours. Have the Fed meeting this week, the inflation scares, I mean, it could go either way, I see. There is talk about the bottoming out of the tech and growth, which I guess it's going to be possible. We could be hitting a bottom right now. And I just wanted to pretty much go over two strategies. No matter where you are in your trading journey, I think we could benefit from this. And I mean, there's basically two schools of thought. And I want to get into this. But first, let's take a look at the NASDAQ. Let me share the screen. Make sure I'm sharing the screen. Okie dokie. So here we are. And I mean, as you can see, this has been in this parallel channel. And this is triple Q, by the way. This is just NASDAQ. It's been in this parallel channel since pretty much 2019 in August. For sure, it dipped a little bit below it in COVID, but right away it went back up into this parallel channel. And when we hit the high in September, right before the September crash, I mean, it ran up. If you guys remember, that was 2020 in September. It ran up. I still remember that was a pretty harsh one right there. But actually, if you consider the technical analysis, all it did was come back to the 50-day moving average. Not that big of a deal, and right, not even down to the bottom support of the parallel channel. And then it eventually got back above the 50-day and then kept going. We had the dip in March, which is this one. That was a pretty big dip. It went from, ironically, actually, it went from the very top resistance all the way down to the support. Bounced on the support, came back up to the 50-day average. A little bit mixed here, and as of recently, we set all-time high at $342.80 for triple Q. Now this is NASDAQ, remember. And that was only maybe 10 days ago. We were at all-time highs. And that's really the biggest issue here. We keep pushing all-time highs, and this is still, there's this transition going to, there's this flow of capital out of growth and tech because of the rising interest rates, because of the 10 years. There is nothing that moves stock prices more than the bond market. Bond market is what moves the stock prices, and as you guys are fully aware, the 10-year is getting up there, although it's not that bad. It really isn't. In my opinion, I don't think it's too crazy. I think it's pretty much about normal. But nevertheless, right now we're back at the support. So that's what I posted in the blog yesterday. I think we are probably going to be at a good buying point. And a lot of people are saying that we are at the bottom for tech, and it's about to bounce, also growth, whatever. And I mean, even today I saw an article, Warren Buffett's Berkshire Hathaway is selling all of their Wells Fargo, which is interesting because financial sector is not doing bad. Financial sector is doing pretty well. If we take a look at the financial sector bull ETF, I mean, it's all-time high even sooner. It's never below the 50-day moving average except for just pretty much a brief period last January. And then before that, I mean, back in October. So the financials have been doing extraordinarily well. And I will highly recommend this ETF. It's a 3X. It's, the ticker is FAS, financial sector. So it's interesting because Warren Buffett actually selling this. So, you know, what does he know that we don't? But nevertheless, the point is, for myself, are we at the tech bottom or not? I mean, that's really what people want to know. You know, stop beating around the bush. Is this the bottom or not? Should we buy growth? Should we sell the growth? I mean, in my opinion, if you want to be conservative, wait for a bounce. Eventually, the growth is going to short squeeze a little bit, and then you could get out of it. Get out, take some profits on some, cut your losses on some of the tech and growth, move the money into some dividend stocks or the financial stocks or even energy if you want to, and just kind of ride this out until we have a better picture of what the inflation and the sentiment and basically how the market is going to move. When the market is going to move. That would probably be my biggest advice if you want to be safe. Now, eventually, tech is going to bottom. Is it now? Well, I mean, there's a high probability. Why not? We are at the support. We are at a buying opportunity. And let me pull this back up of the QQQ. Out of every single time it hit the support. 1, 2, 3, 4, 5. And that was in the past year. Past 8 months. It's hit 5 times. And all 5 have been a good buying opportunity. I don't think that it is inherently super risky to be buying tech right now, especially if you're just buying triple Q or T triple Q, which is the triple Nasdaq. You know, I don't think that that is necessarily a very risky move. Now, if you need the money right now and you cannot afford for this to pull back to the 180 day, you know, there's nothing saying that this is not going to go below this. It has before. Although it was a COVID crisis that pushed it below this support. It was the COVID crisis. Now, this can be an inflation crisis. There's nothing saying that that is not going to break the support. These are lines on a chart that I have drawn. They're not. I'm not a fortune teller, and nobody is. No matter who you hear, no matter if it's so-and-so billionaire, whoever talking about that this is the bottom, we should buy this, sell this. I mean, it doesn't really matter. Nobody really knows. So the safest thing to do is if you need the money, if you cannot afford to keep buying in dollar cost averaging in all the way down to the 180 or even maybe a little bit further, then this one might not be the best time to go into this. And then specifically talking about growth, there are so many growth stocks that the charts look like this. We made highs around February, had the March crash, pulled back all the way to the 180-day moving average on the day chart. And then we're basically doing the McDonald's golden arches, can't decide which way it's going to go. And recently, it's even worse. It's broken the basic support level here, which would, this is the ARKK, Kathy Wood, ARK Innovation and Growth ETF. This is just no special reason I'm showing you guys this, but this is literally what a bunch of growth stocks charts look like. So we just talk about this one because this is just the Innovation and Growth ETF. But nevertheless, if it holds down here, yeah, it could be a good time to buy it. But there's nothing saying that it's going to. I mean, it can go further down. But see, that's the thing is eventually those financial sector, I mean, that's pretty high. You see what I'm saying? This is, we're like 1 or 2 days away from all-time highs. Okay? And also we can look at the energy one too. Yeah, we are also 1 or 2 days away from all-time highs on the energy bull 2X ETF. So, I mean, there is a risk of doing that. So, I mean, you can make an amazing argument, in my opinion. And maybe that's even what Warren Buffett is doing. I mean, no, he's not actually going to buy ARK or any of these growth small caps and whatnot. But You can make a lot of money though if you're timing this right. But again, we don't know if this is going to be the bottom. It can go lower. Even the triple Q can go lower right now. So, you know, if you are willing to be a little bit more risky and say, you know what, this is a great opportunity. If I can buy ish at the bottom-ish, dollar cost averaging, you know, around, try to find the bottom, wait for it to bottom out. Could take another month, could take 2, 3, 4. Doesn't matter. Dollar cost average. I mean, this could set you up for making a lot of money in the years to come. Maybe the next 2, 3 years, this could just take off because eventually it will. Like I said, those financial ones, the Wells Fargo of the world, the Berkshire, the Chase, the Goldman Sachs, the different energy ETFs and stuff like that, eventually all of the good news is going to get priced in. It always happens like that. Just like everything got priced in February for tech and growth. Well, here we are. So the money went into something that's undervalued, which was the cyclicals, financials, yada, yada. And eventually that's going to get priced in. And then the money's going to flow back. Eventually it will. If you take a look at Apple, Apple's been getting beat down. Apple is not a bad company here. It's on the 180-day moving average. Every time it has got to the 180-day moving average, it has bounced. Like here. That's a nice little support that it found. It's right on the support again. Of course, the COVID brought it down, so there's our crisis. It can push further past this support on the 180-day. It just depends if there's a crisis, which we could have a crisis. You see what I'm saying? But if you want to take a little bit more risk, I mean, the point is, if you want to take some risk, if you want to try to get into these right now and set yourself up for some insane growth in the years to come, it's not a bad time. That is just one school of thought. People are starting to buy the tech dip. Actually, a lot of these companies are finding bottoms right now. Of course, it can go lower. Who knows? But as from what I see, a lot are finding bottoms, even for S&P and NASDAQ, like we looked at the charts before. You know, they are hitting on the supports and they seem to be bouncing, which there's a high probability of a bounce in my opinion because the last 5 out of 5 times it's bounced. So we will see. But you know what? We could be temporarily up right now. This could be a whole nother McDonald's arch. And once we get to the McDonald's arch again, maybe it's time to take some profits. Maybe the inflation worries are not going to go away. Maybe you're just tired of your portfolio just getting beat and beat and beat down. Maybe you can't take it anymore. I don't know. Maybe you want to be more conservative. There's nothing wrong with that. In a high inflationary environment, tech and growth is not the right stocks to be in. It's just simple as that. When the bonds are going up, the yields are going up, and God forbid they raise the interest rates. Oh my goodness. Even considering maybe they're going to raise the interest rates early, look what happens to tech and growth. So just wait until they actually raise the interest rates early. Or start manipulating some things, buying back those bonds. In my opinion, we might see a 20% correction. Now, they keep telling us it's going to be until 2023. Okay. But with all of the inflation, the used cars are up, the shelter is up, food, the prices are rising on everything. There's an argument to be made. Maybe it's all BS what they're telling us. Don't believe anything the government's telling us. And be safer with your money right now because they might start doing it early because cannot just the shelter and the prices of food and everything cannot just, or even used cars. It's something like 20% or something like that. Cannot keep going up. They're going to have to do something. That's the argument. It's a good argument. I see both. I think both of these school of thoughts are legitimate. And I think the arguments to be made are both excellent. So let's say we're in this McDonald's Golden Arch M. So once it hits up there, once we see a little bit of a bounce, no matter if this is ARC K or Triple Q, I mean, maybe it's time to take some profits. Take some profits and buy some more safe stocks that are going to do well in a high inflationary environment. Like you could make an argument for dividend stocks. And I mean, it's another valid strategy during this. And at least you're going to get some dividend nevertheless. But I think that one we could look at, just one for an example, is a dividend ETF. This is basically going to sum up how dividends are doing in this environment so far. Like we already looked at the financial sector ETF. It looks very similar to this dividend ETF. And this is not a leveraged ETF or anything like that. Make sure I'm sharing the screen. Yep, okay, dokie. So this is SDY. And this is just a S&P 500 dividend ETF. It pays out about 3% dividend yield. It's been doing really well, clearly above the 50-day moving average. I mean, it for sure dipped a little bit with the COVID. Most everything got killed. And it's already recovered very nicely, and it's already making new highs. And it just hit all-time high not too long ago. It's a similar story. These cyclicals, the dividends, the safe ones, the charts look like this. The growth and innovation, they look like that. Almost everything, except for some big names that have a huge market cap. But that's a different story. But nevertheless, this one's getting 3%, and this one's going to do very well in a high inflationary environment. Even O, we can take a look at O, Realty Income. This is another great dividend stock. And even O is not doing so well this year. But once the real estate and the lumber and everything started just getting really inflated, appreciating really fast, almost like a short squeeze of real estate. But anyways, and you can see it took off here. It finally broke out of this channel. And it's bouncing back on the 50-day moving average. And, it's been trading around the 50-day. So that's nothing too interesting for me. Although, if you can buy it right now, I would say it's not bad. You're going to get a 4.5% dividend every single month. You're going to get paid. Now it's 4.5% per year, but you're going to get the check in the mail every single month. They're paid out every single month. So you can, if you have the DRIP, dividend reinvestment program, you can compound your dividends every single month. I mean, hey, it's pretty good. It's like a rent check because they deal in multifamily homes, commercial offices, different types of real estate, and they're renting them out, apartment complexes, whatever you want. And yeah, so with the real estate going up this year, I think it's not a bad idea. And you're getting some dividends also. Another one you could do is AMT, American Tower. They do it's another REIT. Their percent is only about 2% dividend yield off the top of my head. Let me check this out. Where is it? Dividend yield, yep, 2.02% dividend yield, and that's per year. They're going to pay out quarterly like most of them. But they deal with the real estate for the cell phone towers, the 5G towers. They're buying this land and developing it and then leasing it out. So it's also an interesting play. And if you look here, they've done very well, actually. If we go to the month chart, so this is a pretty good company. I like it. But anyways, that's just another example. I mean, we could look at the SCHD, Schwab dividend. This is just an ETF. But nevertheless, guys, you would be able to figure out, I think this one's about 3.5% or something like that. But you would make a decision. You could split the money up between a lot of them. And I mean, they're almost exactly the same. Whichever one pays more dividends, in my opinion, is probably the one you'd go with. Or whichever one you have access to. But as you can see, this one looks similar to SDY. And then there's another one, VOIM, Vanguard High Dividend Yield. Yep, it literally looks the exact same. Now, these companies, these ETFs, they're going to have companies like AT&T, although that one might not be good anymore. That's another story. Because of the merger they might, with Discover, they might cut the dividend and have ExxonMobil, Chevron, different companies like this inside of just the good dividend paying ones inside of these ETFs. So it's kind of interesting. Instead of just buying a bunch of the companies, you could just simply put it in a dividend. But of course, it's going to get an average of the dividend yield. So maybe if you really care about the dividend yield, you could just go straight O or something like that, or Chevron, which has a 5.5%, and so does ExxonMobil, also has 5.5%, instead of going with one of these ETFs and getting 3. But then again, you're diversified, and that might be worth it for you, or maybe you don't care about diversification. Maybe you're bullish on oil. Of course, it's up to you. But nevertheless, so, point is, maybe when this does, the markets do bounce up with the tech and growth, eventually it's going to short squeeze because these are going to get priced in. It might not be indefinitely. It might go up and then it might come back down, let's just say, to keep it simple. It could be a good time to take some profit and move some into these safer stocks that do perform very well, no matter if it's the FAS, Financial Sector Bull, or the SDY, or the O, or whatnot. It would be possibly a good opportunity to play it a little bit more safe. Or maybe you would do both. I mean, there's nothing saying you cannot do both. 50% of your portfolio, or maybe let's say 45% of your portfolio, the safe dividends, 45% of your portfolio, nice juicy ETFs buying the dip on the NASDAQ, ETF, S&P, triple ETF, I mean, you know, some juicy ETFs like that, and then the rest 10% you could put into some small cap growth. Could even do a TNA. But anyways, the choice is yours. Only you can answer the question. It depends on your risk tolerance. It depends on a lot of things. Which school of thought are you? Are we at the bottom of this dip? Or is this the perfect opportunity to take some profit? Because guess what? It looks like the markets are going up today. Last time I checked, the NASDAQ was up 0.76%. So it's even more than it fell yesterday. So it could be an interesting week. But anyways, guys, keep in mind, I'm doing the webinar series. So if you go to prostockadvice.com/webinar, you can see when, or sorry, /seminar. Is it seminar webinar? I'm confused. I don't even know what to call it. But we are doing the 101, which is starting on this Sunday. So if you want to register for this, we're going to be covering everything from leaps to wheel strategy, allocating cash in a portfolio. And it's a 3-part series. So every Sunday we're going to do at 9 a.m. EST. And it's only $90 per person, around an hour class, something like that. But just to get some basic idea of some more in-depth option strategies and with the real world examples. And also we're going to be doing, once those 3 weeks conclude, we will do the 201, which is going to go more into the condors, iron condors, the technical analysis, which we will start getting into more in the 200 series. But anyways, guys, let me know what you think of that. I got some good feedback on the first one, so if you want to do it, hit up my email, DMs, doesn't matter, and we will get it scheduled. The spots are filling up soon. I am keeping this small because it's a live class. It's not pre-recorded, so I'm not just going to sell like 1,000 spots or whatever. So I will keep it small and give everybody an opportunity to get their questions answered, and we can talk about it and stuff like that. So it's actually pretty cool, and I have a lot of fun talking with you guys anyways. So anyways, guys, follow me on Twitter. We're not doing so much live trading. Like I said, I don't know how much content I can push out this week. Got some stuff going on. But anyways, guys, I appreciate you and see you on the other side. Peace.